Why do investors fear risk only after it is already struck? Why do we rush into the market when everything feels safe, only to retreat when safety has already vanished? It's a paradox as old as the stock market itself. When prices rise and confidence fills the air, the real danger hides quietly beneath the surface. And when panic spreads and headlines scream crisis, that is often when risk is already retreating. Benjamin Graham understood this paradox better than anyone. He saw that most investors don't see risk, they feel it. And feelings, he knew, are a terrible compass for navigating uncertainty. To Graham, the idea of risk was not about the daily ups and downs of the market. It wasn't about volatility or beta or the speed at which a stock price moved. Those were surface ripples. The real risk, the one that destroys wealth quietly and completely, was the risk of permanent loss. As he once said, the essence of investment management is the management of risks, not the management of returns. That distinction changed everything, because it meant that real investors don't measure risk after the fact, when prices fall. They measure it before they buy, by understanding what they own, what they're paying for it, and how much margin of safety they have built in. And yet, most of us still treat risk as something mysterious, something external, something the market does to us. But Graham would remind us that risk, like character, is revealed only under pressure, and it begins long before we ever see a loss on a screen. So, before we can learn how to evaluate risk, we must first understand where Graham's wisdom on the subject was born, in an era when nearly everyone forgot that risk existed at all, until it was too late. In the roaring 2019s, Wall Street was not a place of caution. It was a theater of confidence. Stock prices rose almost every month. Fortunes appeared overnight, and Benjamin Graham, a young man of exceptional intellect, was among those rising stars. By his early 30s, he had built a reputation as one of the most brilliant analysts in New York. He taught at Columbia, managed money successfully, and was admired for his ability to find undervalued opportunities where others saw none. The world seemed rational, predictable, even safe. But beneath that glittering surface, the seeds of disaster had already been sown. Speculation had become a national pastime. People borrowed money to buy stocks confident that prices would always go up. The market was not measuring value, it was measuring emotion. And then came October 1929. The Great Crash erased years of illusion in a matter of weeks. Stock prices fell by more than 80%. Fortunes disappeared. So did confidence. Graham himself lost nearly two-thirds of his investment fund. The man who had believed in his analytical skill was forced to confront a brutal truth. No matter how intelligent the analysis, no one was immune to overconfidence or to the blindness that prosperity breeds. This was the crucible that shaped him. From that experience, Graham did not become cynical. He became wiser. He realized that what most investors call risk is usually just discomfort, temporary price swings, market noise, or volatility. But true risk, the kind that destroys wealth permanently, comes not from the market, but from the investor's own decisions. From paying too much, from ignoring financial strength, from trusting the crowd, and from forgetting that uncertainty is the natural state of markets. The Great Depression transformed Benjamin Graham from a skilled speculator to a disciplined investor. It taught him humility, it taught him patience, and most importantly, it taught him that the first duty of every investor is not to make money, but to avoid losing it.
As he later wrote, the essence of investment is the margin of safety. It was not a slogan, it was a shield forged from experience. That insight would become the cornerstone of his philosophy. From that moment forward, Graham's focus would shift away from predicting markets toward understanding value, strength, and protection. He would ask not, how high can this stock rise, but rather, how much can go wrong before I lose? Nearly a century later, that remains the most important question any investor can ask before buying a stock. And yet, very few do. To understand why, we must first examine what Graham truly meant when he redefined the word risk. When Benjamin Graham redefined risk, he did something revolutionary. He stripped away the layers of jargon, emotion, and theory that had accumulated around it. He looked at investing as a business person would, calmly, logically, and with a long view. To him, risk was not volatility, it was the probability of permanent loss. A temporary drop in price did not frighten him if the underlying value remained. But a poor business, an inflated price, or an undisciplined investor, those were true dangers. Modern finance, of course, often disagrees. Today, risk is commonly defined by beta, a mathematical measure of how much a stock's price moves compared to the market. If a stock swings wildly, the theory says it's risky. If it moves steadily, it's safe. But Graham saw through that illusion long before beta existed. He understood that price movement tells you nothing about value, and therefore nothing about true risk. As he wrote, an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. In those few words, Graham offered a complete map of risk: safety of principal, protection against permanent loss; adequate return, compensation for assuming uncertainty; and the dividing line between the investor and the speculator, analysis and discipline. Let's illustrate this with an example. Imagine two investors buying the same stock. One buys it after deep study. He understands the company's earnings, its balance sheet, and its competitive position. He pays a price far below its intrinsic value, leaving a comfortable margin of safety. The other buys it because everyone else is, because the chart looks good, or because it's hot. The first investor is exposed to market volatility, yes, but not necessarily to risk. If the price drops, he may lose nothing but time. The second investor, however, owns a speculation wrapped in confidence. If the narrative changes, his entire position could vanish, not because of the market, but because he never measured what he was truly buying. That, Graham taught, is the essence of investing versus speculation. The investor looks down before he leaps. The speculator only looks up. And the real test comes not when prices rise, but when they fall. When the crowd panics, the investor who has measured risk before buying is calm, not because he's fearless, but because he's prepared. He understands that temporary decline is not danger, it is opportunity. Risk, then, is a matter of structure, of how your investment is built. It lives in the relationship between price and value, between debt and equity, between emotion and reason. Graham's message was clear. If you cannot define risk clearly, you cannot control it. This redefinition shifted the entire philosophy of investing. It replaced the question, how much can I make, with how much can I afford to lose and still be right? And once you begin to think this way, your entire perception of the market changes. Because suddenly the goal is no longer to predict the future, it's to survive it.
But how exactly did Graham measure this invisible force, this probability of permanent loss, in practical terms? That's where his method, the disciplined framework of the intelligent investor, comes to life. Benjamin Graham believed that risk could never be eliminated, only understood and managed. And the way to do that was not through prediction, but through preparation. In his world, analysis was a form of protection. Every number, every ratio, every assumption served a single purpose: to answer one simple question: how much can go wrong before I lose? Let's walk through the pillars of Graham's approach, the framework he used to measure and control risk long before the word quantitative became fashionable. 1. The margin of safety, the core principle. To Graham, the margin of safety was not just a concept, it was the moral foundation of investing. He defined it as the difference between the intrinsic value of a stock and its market price. That gap, that cushion, was the investor's shield against error, uncertainty, and time. If a company was worth $100 a share by conservative estimate, Graham would insist on paying no more than $70 or even $60. Why? Because he accepted his own fallibility. He knew his calculations could be wrong. The future could disappoint, or conditions could change. The margin of safety absorbed those shocks. It turned uncertainty into opportunity. It transformed risk from a hidden threat into a visible, measurable quantity. As he wrote, the function of the margin of safety is, in essence, that of rendering unnecessary an accurate estimate of the future. 2. Financial strength and stability. Graham also measured risk through a company's balance sheet. He knew that even the best business could fail if burdened by too much debt or too little liquidity. He looked for companies with strong current ratios, manageable debt levels, and consistent earnings across economic cycles. In security analysis, he noted that a firm's ability to survive adversity was a far better indicator of safety than its growth potential. He preferred the sturdy to the spectacular, because durability, not excitement, is what protects investors from permanent loss. In his own words, obvious prospects for physical growth in a business do not translate into obvious profits for investors. 3. Earnings stability and a record of performance. Risk also lives in inconsistency. A company that earns money year after year, through booms and busts, tells a story of resilience. Graham often required at least 10 years of continuous earnings before considering a company suitable for defensive investors. He knew that past results do not guarantee the future, but they reveal character. A firm that has weathered storms before is more likely to survive again. And survival, in Graham's philosophy, is the true victory of an investor. 4. Valuation discipline. Perhaps Graham's most underappreciated risk control was valuation discipline. He refused to let optimism determine price. He distinguished sharply between price, what you pay, and value, what you get. Even a great company can become a bad investment if purchased at an inflated price. He warned that the chief losses to investors come from the purchase of low-quality securities at times of favorable business conditions. In other words, when everything looks good, that's precisely when you should be most skeptical. Graham's formulas for intrinsic value, whether based on earnings power, asset value, or dividend yield, were all designed to ground the investor in reality. They force discipline where emotion usually reigns. 5. Diversification, the final layer of protection. No matter how careful the analysis, Graham accepted that error was inevitable. Even the most skilled investor could be wrong. His solution was broad diversification, not as an act of fear, but of humility.
By spreading investments across different businesses and industries, he ensured that no single mistake could inflict lasting harm. To Graham, diversification was not an admission of weakness, it was an expression of respect for uncertainty. When you combine these 5 principles, margin of safety, financial strength, earnings stability, valuation discipline, and diversification, you arrive at Graham's complete defense system against risk. He could not rely on prediction or instinct. He relied on structure. Each element reinforced the others, forming a web of rational protection. And in that web, the intelligent investor found freedom, not from loss, but from fear. Nearly a century later, in an age of instant data and endless volatility, Graham's structure remains the quiet antidote to chaos. But how do these timeless rules hold up in today's world? A world of meme stocks, zero interest rates, and algorithmic trading. To answer that, we must bring Graham's wisdom into the modern age. Nearly a century has passed since Benjamin Graham first taught his students at Columbia that an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. And yet, that definition may be more radical today than it was in 1934. We live in an age where speed has replaced thought, and confidence has replaced analysis, where investors chase where is rising, not because they understand it, but because they fear missing out, where risk has been disguised beneath technology, liquidity, and convenience. But no algorithm, no trading app, no new asset class has ever changed the basic laws of human behavior. And it is human behavior, not the market, that determines risk. The illusion of safety. In recent years, markets have seen extraordinary calm, followed by sudden storms. Cheap money and optimism inflate prices far beyond their underlying worth, and then the air rushes out. Every time, the same pattern repeats. When prices rise, risk appears low. When prices fall, risk feels high. But the truth, as Graham would remind us, is precisely the opposite. The more enthusiasm investors feel, the greater the risk they are running, he wrote. In euphoric times, risk hides beneath comfort. In fearful times, safety hides beneath panic. This inversion of perception, the eternal rhythm of greed and fear, is what makes Graham's principles timeless. Volatility is not risk. Modern finance still clings to volatility as a measure of risk, as if the movement of prices could capture the fragility of value. But volatility is emotional. It is the pulse of the crowd. Graham's definition, the chance of permanent capital loss, remains the only one that truly matters. Consider this. A high-quality business whose price falls 20% because of market turbulence has not suddenly become more risky. If its earnings, balance sheet, and competitive position remain strong, its risk has likely declined because the price now offers a greater margin of safety. Conversely, a hyped company trading at 100 times earnings may appear safe while rising, but it sits on the edge of disaster. When expectation collapses, there is no cushion, and risk becomes reality. The modern face of speculation. Speculation today wears many disguises: day trading, meme stocks, cryptocurrencies, leveraged ETFs, and even overconfidence in blue chips. But the underlying psychology is the same as in Graham's day: the desire to get rich quickly without understanding what one owns. Graham would not condemn speculation entirely. He simply insisted that it be recognized for what it is. He wrote, "There is intelligent speculation as there is intelligent investing.
But there are many ways in which speculation may be unintelligent. The moment we deceive ourselves, the moment we call a gamble an investment, that is when risk becomes invisible.
Why Graham still matters. In the modern world, information is abundant, but wisdom is scarce. Investors today can see every tick, every fluctuation, every opinion, but few stop to ask, what is this business truly worth? And that, Graham would argue, is where real risk begins, not in uncertainty, but in unexamined certainty. When everyone believes prices can only go higher, when analysis is replaced by optimism, that is when danger is greatest. He taught that rational investing requires an independent mind, not independence for its own sake, but because markets are driven by crowds, and crowds by emotion. As he once warned, "You are neither right nor wrong because the crowd disagrees with you. You are right because your facts and reasoning are right." That truth remains the investor's compass in a world of noise. The timeless formula. If Graham lived today, he would still follow the same method. Analyzing financial strength, measuring margin of safety, diversifying intelligently, and refusing to pay for perfection. He would not try to outguess the market, but to outlast it. He would look at each share not as a ticker symbol, but as a real ownership in a real business. Because in every age, risk hides where reason sleeps. And the only defense is disciplined thought. Graham's wisdom, then, isn't a relic of an old market. It is a survival guide for every market. It teaches us that the tools may change, but the human mind does not. And so long as greed and fear rule the market's rhythm, his lessons will remain the quiet truth behind every crash and every recovery. But beneath these analytical ideas lies something even deeper, a psychological truth about human nature. Because risk, before it ever appears on a balance sheet or a price chart, begins inside us. Benjamin Graham often reminded his students that the most dangerous kind of risk doesn't come from the market, it comes from within. He wrote, "The investor's chief problem, and even his worst enemy, is likely to be himself." In that one sentence lies the quiet truth about every financial crisis, every market bubble, and every personal loss that could have been avoided. Because before any mistake is made with money, it begins as a mistake in judgment. The two faces of human nature. Graham saw the market as a living reflection of our collective psychology. He personified it in one of the most enduring metaphors in all of finance. Mr. Market. Mr. Market is not evil. He is emotional. Each day he offers to buy your shares or sell you his, sometimes at sensible prices, sometimes at absurd ones. When he is euphoric, he overpays. When he is depressed, he practically gives his assets away. The intelligent investor, Graham said, must treat Mr. Market as a servant, not a guide. He exists to offer opportunity, not direction. Yet most investors do the opposite. They take their cues from him. And in doing so, they turn opportunity into danger. Fear and greed, the eternal cycle. Every generation believes it is smarter, more rational, more data-driven than the last. Yet the two oldest emotions, fear and greed, still dictate the rhythm of markets. Greed blinds us to risk. Fear blinds us to opportunity. And both stem from the same illusion, the belief that we can know what comes next. Graham's wisdom was not about eliminating emotion. He knew that was impossible. It was about recognizing it, controlling it, and never allowing it to make the final decision. He once said, "The best way to measure your investing success is not by whether you're beating the market, but by whether you've put in place a financial plan and a behavioral discipline that are likely to get you where you want to go." This is the essence of emotional control. Not the absence of feeling, but the mastery of temperament.
Humility, the forgotten virtue. Humility, to Graham, was not weakness, it was strength. He believed the intelligent investor must begin from the assumption that they can be wrong. That's why he built margin of safety into every decision, not as pessimism, but as respect for uncertainty. He understood that markets are complex systems shaped by countless variables beyond our control: politics, innovation, human emotion, and time itself. To pretend we can predict them is arrogance. To prepare for them is wisdom. And that humility, that acceptance of what cannot be known, is the foundation of genuine confidence. Not the fragile confidence of short-term gains, but the quiet assurance that your reasoning, not your emotions, guides your choices. Rationality as a moral choice. For Graham, rationality was not merely a mental discipline, it was a moral one. To think clearly, to act with patience, and to refuse to follow the crowd when it loses its head. These were not just strategies for success, but principles of integrity. He urged investors to build their habits around truth, not fashion, to be willing to appear wrong in the short term in order to be right in the long term, and to remember that, in his words, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. That single distinction defines the difference between appearance and reality, between speculation and investment, between fleeting excitement and enduring value. The psychological margin of safety. Graham's concept of margin of safety extended beyond numbers. It was also mental. A psychological margin of safety meant being comfortable with temporary loss, patient with delay, and skeptical of perfection. It meant not needing the market to agree with you to feel secure. Because, as Graham taught, true safety doesn't come from avoiding uncertainty, it comes from being prepared for it. And that is why risk, in the deepest sense, is not about what happens outside of us. It's about whether our inner foundation, our logic, patience, and discipline can withstand the turbulence of the world. So the next time you feel the pull of greed or the sting of fear, remember Graham's quiet challenge. Have you measured your risk or just your emotions? Because if you can control your temperament, you can control your destiny as an investor. And in that self-control lies a kind of freedom that no market storm can take away. And now, with Graham's psychological insight in mind, let us return to the practical realm, where reason meets action. Because philosophy alone doesn't make you safe, behavior does. So how can you, as an investor today, apply these timeless lessons to evaluate risk before buying any stock? Benjamin Graham's teachings were never meant to stay in textbooks. They were meant to be lived through the decisions we make each time we invest and the discipline we show each time we are tested. So let's bring his wisdom down to the ground, into the practical world of evaluating risk before buying any stock. 1. Start with the business, not the price. Before you look at a stock chart, look at the business. Ask, what does this company actually do? How does it make money? A true investor sees shares not as lottery tickets, but as ownership in a living enterprise. If you don't understand the business, you cannot measure its risks, because you cannot see what could go wrong. Graham warned that investment is most intelligent when it is most businesslike. That means studying the company as if you were buying the whole thing, not just a piece of paper.
2. Demand a margin of safety. No matter how attractive an opportunity appears, never pay full price for optimism. Calculate the intrinsic value as conservatively as possible and insist on a margin of safety. This is not about precision,
It's about protection. Graham's point was not to find a perfect number, but to give yourself room for error. Because investing is never about being right, it's about not being ruined when you're wrong. 3. Examine the balance sheet. A company's strength is revealed not in its press releases, but in its balance sheet. Look for liquidity, manageable debt, and consistent cash flows. If a firm must constantly borrow to survive, it is already living on borrowed time. Graham favored conservatism, businesses that could withstand recessions and setbacks without relying on the kindness of capital markets. As he might say today, if a company cannot endure difficulty, it does not deserve your confidence. 4. Separate price from value. The market's job is to quote prices. Your job is to determine value. Confusing the two is the root of nearly all financial pain. When prices rise, remember, value may not have changed. When prices fall, remember, value may still endure. The intelligent investor does not ask, will it go up? He asks, is it worth it? And if it isn't, no excitement, no trend, no crowd can make it safe. 5. Diversify, because you will be wrong. Even with careful analysis, error is inevitable. That is why diversification isn't weakness, it's wisdom. It spreads the impact of the unknown across multiple holdings, insulating your capital from the failure of any single judgment. In Graham's philosophy, diversification was humility turned into strategy. It said, I may be wrong, but I will not be destroyed. 6. Master your emotions. No spreadsheet can protect you if your temperament betrays you. The greatest losses come not from miscalculation, but from emotional reaction, selling in panic or buying in euphoria. Build a psychological margin of safety as deliberately as a financial one. Decide in advance what you believe, what you own, and at what price you would act before emotion enters the room. In a world that worships noise, silence is your advantage. 7. Think in decades, not days. Risk fades with time, not because uncertainty disappears, but because value reveals itself. Short-term price movement is chaos. Long-term, it is truth. To think in decades is to free yourself from the tyranny of daily fear. As Graham's most famous student, Warren Buffett, later echoed, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Time is the friend of the rational investor and the enemy of the reckless one. So how do you evaluate risk before buying any stock? You do what Benjamin Graham taught nearly a century ago. You replace emotion with evidence, replace prediction with preparation, and replace impulse with patience. You ask the unglamorous questions. What could go wrong? How much could I lose if I'm wrong? And what margin of safety protects me from the unknown? Because the truth is simple, yet profound. You cannot predict the market. You cannot control the economy. But you can control your judgment, and that is where true safety lives. As Graham wrote, to achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks. The secret is not brilliance, it is discipline. In the end, the intelligent investor's greatest reward is not wealth, but peace. The quiet confidence that comes from knowing that every decision was made with reason, not emotion. That is how Benjamin Graham taught generations to survive uncertainty, and how you too can stand calmly in any storm. If you found value in this exploration of Graham's philosophy, consider subscribing to Benjamin Graham Value Insights. Here we preserve and share the timeless lessons of the father of value investing, so that reason, discipline, and humility never go out of style. Because in every age, markets change, but wisdom does not.